welcome along to the Property Academy podcast by Opus Partners. I'm your host, Henry Knight. And today's show, we are talking about the hidden risks of developer-provided cash flows, because I have seen some relatively misleading financial information being put out to property investors by property developers at the moment. And I think it's really important that we, A, call it out, but also go through some of the things that we're seeing so that you as a property investor at home can be aware of what to look out for if you are reviewing any sort of financial information given to you by a developer. And I recently received an email from a listener of the show, Johnny, who said, "Hey Ed, I like Williams Corp. I own one of their houses, but the cash flow figures they provide in the information pack, linked below, really don't stack up. Might be an idea for a podcast. I'll pass it along." Now, I'd actually reviewed these cash flow figures provided by Williams Corp and mentioned it to their managing directors, and I wasn't going to record a podcast about this, but then Johnny emailed me and I thought, oh, why not? It's a fascinating topic. Now, the subject line for the marketing email sent out by Williams Corp was CBD Christchurch Homes with a 12.5% gross yield.
Good gross yield.
Enormous gross yield. 12.5%, you'd expect it to be about 4 to 5% these days. And so we scroll down and we start looking at the property pack, and they're selling it exclusive of GST, and they're saying it's a 12.5% gross yield if you're using it as short-term accommodation, and they've provided some cash flow figures. So if we dig into that cash flow, what do we see?
This was your Sunday night, wasn't it, Ed?
Oh,
you love a Actually, sorry, it was Saturday night, wasn't it?
This one was on Saturday night before I went out drinking at the bars. So $850K exclusive of GST. They're suggesting you might put $170,000 cash deposit in, and that we're going to have an occupancy rate of Airbnb of about 84%.
I just want to point out here, the deposit of $170, that's a 20% cash deposit. Now, one thing to remember is you actually have to have the cash to be able to make these numbers work. Now, for a lot of investors, we would say, yeah, you'll have a 20% deposit, but that's against your own house or another investment property. So therefore, you've got a higher mortgage. So you've got to make sure when you are looking at, see, somewhere like the bank loan here is $680. Yep. That's probably only the case if you, it is only the case if you've got the $170K in cash.
That is exactly correct. Now, the numbers look pretty good. We've got all of it here. And it's
good capital growth rate assumption, though, 3% per annum for an inner city apartment. I think that's probably not bad.
I think that's probably a bit conservative, if I was honest. But the key thing that I want to point out is that they're suggesting it's going to be $18,000 cash flow positive. That's before tax. And you think, gosh, that's really good when you've got a mortgage of $680,000 at 6.5% interest. And then I started digging into it a bit. So they're suggesting that the average revenue per night is going to be $350 per night, exclusive of GST. Now, if you include the GST, it's going to be $402.50 a night. And at first I thought, oh, that's pretty punchy. I wonder if that's reasonable or not. And the beautiful thing, Andrew, is that if I zoom out, right next to this cash flow, we've got a rental appraisal from Ohana, which is an Airbnb management agency. Now, what do we see here? They're suggesting that the average nightly rate is $199. But if it's a weekend, it's $299. And in peak season, that you might have $350 to $400 a night. That's peak season and public holidays. And they've also got some conservative estimates for what you might expect per week. Now, the interesting thing here is that the average nightly rate based on Ohana's, which is their gross weekly estimate, is about $242 per night. Okay, so they're assuming $242 per night, but the cash flow is done on the basis of $402.50 a night. Okay, that's not adding up. On top of that, they're suggesting an average nightly rate of $402.50 a night, but that is above the top range for peak season and public holidays. So they've effectively run the cash flow as if every day is a public holiday, which, to be fair, Andrew, these days with the number of public holidays, it does sometimes feel like that, but it's actually outside the top end of the range. So that, to me, does not seem like it is going to be at all realistic.
So I've got a question for you. here. So for the estimated occupancy, say we went on 85% at 299. Have you done the numbers based on that?
I haven't done it based on 299 because, again, not every night's a weekend, but I have done the numbers based on the average earnings that Ohana is saying, which is about $242 a night. I'll take you through the cash flow in a minute, but just before we get into that, I do want to show you as well that there is one of these properties currently available on Airbnb, and I must admit the photos of the property, it looks quite nice actually. I think they've done up the property quite nicely.
Cool.
Can you see there's a foosball table in there?
And what's that? One of those game machines?
Yeah, we get to, they're basically gambling, isn't it? Where you've got to pull something out and, there's a claw and it goes down at the arcade. I think they've done the property up quite nicely in terms of whoever is Airbnb-ing this at the moment. They've got an Xbox in there. But the question is, what are they renting it out for? Because that's what we're trying to dig into at the moment. At the moment, it's $215 a night is what they're currently renting it out for. And I've looked at a range of dates, and it appears to be around about that, about $215 a night. For a single night, they're trying to get $450, but for most of them, it's around that $215 mark. So that might be one of the peak seasons. And if we run same assumptions as Williams Corp, instead of being positive cash flow $18,000 pre-tax, you're now negative $13,000 pre-tax.
That's a big difference. Can we go back to where that is?
So the major difference is in the average revenue. So they're suggesting $350 a night, including GST. The Ohana rental assessment provided by the company suggests it should be around about $210 a night, excluding GST.
Now, again, this is based on an 80% loan, interest only, and a $170K cash deposit, not using usable equity, because if you use your usable equity, you're going to pay interest on that as well.
The other thing here is that the gross yield drops from 12.5% to 7.5%. Now, when you send out a marketing email at gross yield 12.5%, you think, gosh, that's really good. I'm into that. If you put it out at 7.5%, which is what it actually is, you start to say, oh, well, maybe that's not as exciting.
Well, for an Airbnb property, you'd expect that would be about right.
So there's about a difference of, actually, I'll give you the exact difference. So between what I'd consider the correct numbers and Williams Corp's numbers, there's about a $31,000 difference a year in cash flow after you adjust for the rent. But Andrew, that is not the only other large issue that we've found in this cash flow. What's the other one you've found?
So if we go back to the assumptions, one of the things that's been left out is maintenance. Now, remember, with Airbnb, you've got a lot of foot traffic. People are going to be spending a lot of time at this property, actually enjoying the furniture, playing around in that foosball machine. There needs to be an allowance for maintenance. Now, we would normally allow about $2,000 a year in maintenance because stuff gets broken, stuff wears out, not only just in the house, but particularly when you've got a furnished property. So you need to allow another $2,000 a year for that. And then the other part, the accounting at $600 a year seems a bit low for us. We use $1,350 by default, so we've done that here.
The other major issue, and I've got a real bee in my bonnet about this, Andrew, is that they've calculated the GST incorrectly. So this is a company, development company, selling their property or marketing it as if it's exclusive of GST because they're suggesting, hey, you should use this as an Airbnb. It's going to be a GST registered activity. Therefore, you can zero rate the GST and not pay it.
Which means that when you purchase the property, there won't be GST between the two parties. And so that gives you a discounted rate. Now, you might be thinking GST is 15%. So I take 15% off the purchase price, right?
That is not the case.
But that's how a lot of people do it.
So they've actually advertised this property at the wrong price. So in their marketing email, they've said it's $850,000 plus GST. The price is not $850,000 plus GST because if you go to the contract, it is in fact $999,000 including GST. Now, the way a lot of people calculate GST is they'll say, okay, it's $1 million property, let's take off 15%. But that is not how GST is calculated. GST is calculated as whatever the GST exclusive price is add on 15%.
So what is the real price then, Ed?
So the real price is $869,000. It's a couple $100 less than that. It's actually $868,700.
Yeah.
But the way you calculate a GST exclusive price is you take whatever the price is and you divide it by 1.15%, because 869,000 add on the 15% is how you get to that $999,000 price tag.
So about a $19,000 difference. Now, having said that, I know Matthew and Blair well enough to know that if they've advertised something, they'd probably honour that $850K purchase price.
But it doesn't give you a lot of confidence when a developer is advertising something and you see a price in the contract and it's not the same as what they're running the cash flow numbers on. And so this is one of the things that if a property investor was looking at this, you'd be like, hang on, you haven't actually done the math correctly, because that's going to mean you're going to need a higher deposit. But it also means that the gross yield's not going to be as good because you've got the same amount of revenue, but for a higher priced property. So that drops the gross yield further down to about 7.4% rather than 7.5%. One final thing that I want to do is I want to take out that cash deposit. So now we've got the higher purchase price, which means a larger loan. I'm also going to take out the cash deposit, and we're using a more realistic average night of $210 plus GST, and I've taken everything else out.
And look, this is based on our experience. Most investors don't have cash in the bank as their deposit. Some absolutely do, but most do not.
So what I just want to show, though, is the differences that these assumptions make. So in the original cash flow provided by Williams, they're saying that this property is going to have positive cash flow of about $350 a night. When in actual fact, if you don't have a cash deposit and you use the lower nightly rate for rent and you use the higher purchase price, it's actually negative $490 per week. Now, look, I'm going to come out and say something a bit controversial. There is not necessarily anything wrong with having a property, especially a new build property at today's interest rates, with negative $500 a week in cash flow. For some properties, especially if it was in Auckland around that $1 million mark, you would expect it to have negative cash flow of a couple $100 a week. What I object to is a company putting out financial information that is actually incorrect, both in terms of the purchase price and that doesn't match up with some of the other information within their property pack. And Andrew, I realise that within that property pack, there is, of course, a big disclaimer. As there should be. Things like the projected returns on investment, they're an indication only. You know, the company isn't responsible for any representations. You should go get more advice, all of these things. But what I object to is putting out something that is factually wrong. And if you looked at the other side of the document, of the brochure, you'd be able to see that was factually wrong. If you looked at the contract, you'd be able to see that the price was wrong. And the reason that we're recording this is that there is a real risk that property investors, possibly not the people watching this YouTube channel or listening to this podcast, because these people are pretty educated, but people who are out there and just say, yeah, I want to make the $18,000 in positive cash flow, sign up the property, and then realise that this cash flow can't actually be relied on.
Yeah, and I think that's probably the most important point of this podcast today. We want to make sure that people, if you're getting financial advice, that you're getting it from a financial advisor. And look, Williams aren't the only ones giving out cash flows who are developing. I think a lot of developers, if not most of them, sometimes provide some sort of advice on this is a good investment or these are the expected cash flows. If you're going to rely on information from a developer, you need to then take it to a financial advisor and get the numbers checked. And this is a good example of why.
And I really do think that there is a risk that people are going to make bad financial decisions simply because they've relied on information to be true. And look, if you get information from any sort of company, you would expect that they have hired somebody or used somebody with the right amount of knowledge and ability to put together some, cash flow or some sort of investment recommendation that you can rely on. And in this case, that's actually not true. Whoever's put this together, I would say, is probably pretty naive or pretty inexperienced, because if you can't even get the purchase price correct of your own property, it really starts to raise a lot of questions. And look, we did hum and ha about should we record this episode or not, because we don't want to always come across as we're beating up developers for doing bad things. But actually, there is a risk that somebody's going to make a bad financial decision because of this. And it's really important that you guys are aware that sometimes a company will put out a cash flow and it will be misleading. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to see the visual side of this show, check out our YouTube channel. We've released this podcast as YouTube. Just Google Opus Partners YouTube. It'll be the first thing that pops up. Thanks for listening to the Property Academy podcast. I'm your host, Steve Knight. We're going to be back here tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the property market. Until next time.